Value add strategies for commercial properties and how investors create wealth through net operating income or NOI. And in today's commercial real estate or CRE market, waiting for appreciation is no longer a strategy, it's a gamble. And the investors winning right now are doing something different. They're manufacturing value. Value add investing is basically the process of acquiring an underperforming commercial property and improving the overall income performance to drive exponential increases in its value. It's not about timing the market, it's about controlling the outcome. So the core principle here is that NOI drives value. And commercial real estate is valued based on income, not comparable sales. So for an example's sake, at a 5% cap rate, every $1 increase in your net operating income equals a $20 increase in your value. So a $50,000 increase in income is $1 million in value. And that's the multiplier effect most investors underestimate. And this is why the best operators don't chase deals, they engineer them. So let's talk about repositioning from an underperforming asset to an in-demand asset. And a value add is fundamentally about transformation. You take an underperforming asset, you stabilize it, and it becomes an institutional grade asset. And this can include increasing rents to market levels, improving your tenant mix, both from a credit and a use perspective, but also enhancing the tenant experience and fixing operational inefficiencies. And the goal isn't just improvement, it's alignment with current demand trends. So let's talk about execution by asset class. And different asset classes require different strategies. So for retail, think a shift towards experiential tenants, fitness, food, medical. Focus on the destination retail versus transactional retail concept. So for office buildings, add amenities, spec suites, flexible layouts, and cater to hybrid work environments. For industrial, improve your loading process and space, logistics flow, and clear height, but also target last mile distribution demand. Multifamily projects, renovate the units, add lifestyle amenities, and capture rent premiums through those upgrades. Specialty assets, repurpose assets like a hotel into a multifamily or an office or a medical. Operational efficiency, the hidden profit lever. And most investors overlook this, and that's where serious money can be made. If you're reducing operating expenses, that's a direct NOI increase. If you can renegotiate vendor contracts, that'll save you money. Implement energy efficient upgrades like LED, HVAC, or solar, that saves you money. And often the difference between a mediocre deal and a great deal is the management itself and not the asset. So the third place strategy is demand follows experience. The highest performing properties today are not just functional, they're experiential. So think walkable environments or community focused retail and also lifestyle driven amenities. And when a property becomes a place that people want to be, you'll have tenant retention increases, people want to stay, your foot traffic will rise, and your rent premiums will follow. And that's pricing power. So let's talk about risk management and where deals can go wrong. And value add is a powerful, but execution risk is real in those deals. And some of the key risks you got to be mindful of are construction delays and cost overruns, or over improving beyond market rent potential, or misreading tenant demand, or rising interest rates impacting your exit strategy. So top investors can mitigate these by underwriting conservatively, stress testing your exit scenarios, but also maintaining liquidity and reserves, and thinking like lenders, not just buyers. So the strategic insight is that structure will always be rate, and this is where most investors can miss the mark. Value add success isn't just about the property, but it's about how the deal is structured. So winning investors are going to engineer NOI growth, but also structure debt strategically, whether it's bridge, DSCR, or agency, and aligning their hold period with the market cycles. They don't just buy right, they structure right. And those are two very different but important concepts. So the winning formula is the investors who consistently outperform are going to follow this framework. You underwrite like a lender, execute like an operator, and exit like a strategist. And that's how you turn a deal into a portfolio. So the bottom line is that value add investing is one of the most powerful strategies in commercial real estate because it allows you to manufacture equity in your property, but also control outcomes and create asymmetric returns. And in today's market, the opportunity isn't in waiting, it's in the execution, my friends. That is it for the day. Please visit my website. I'd love to have a conversation with you about how we can put some of these strategies into play. My website is houstonrealestatebrokerage.com. Thank you for your time and have a good day.